Welcome to Alternative Investments Chat,
where we demystify the world of alternative investments and financing for entrepreneurs and investors alike.
With these discussions, we hope you're more empowered to unlock opportunities in your business or portfolio. I'm Erin.
And I'm Erica. Let's get started. Welcome back to another episode of Alternative Investments Chat. Today, we're going to explore a topic that can seem a bit technical.
Yep.
But it can actually open up an interesting possibilities for investors. And this is derivatives.
Yep, that's right. Derivatives are often viewed as high risk, but when used carefully and with the right knowledge, they can serve as tools for strategic diversification, the thing we love,
Yes.
income potential, the thing we love more,
Yes.
and managing exposure to market movements. Now, if you're like Erica and you might have a puzzled look on your face, like, what is a derivative?
Yeah.
Great question. We're going to break it down for you. Erica, can you tell us what a derivative is?
Yeah, well, I'm going to do my best. So I definitely had a puzzled look on my face when we got this topic. First thing that came to my mind was the word derivative. And I was like, I'm sorry, I think I failed that in high school.
Math class?
I don't think I passed that course.
Mm-hmm.
But a derivative is actually a financial contract that gets its value from something else.
Okay.
Like a stock, bond, commodity, currency, investment rate, or even another derivative.
Interesting.
Okay. So that something else is called an underlying asset. Imagine you're a farmer growing corn, because we all love corn.
Yep.
And you're worried that corn prices might drop by the harvest time, right? Because you have to spend some time, you got to plant it, you got to water it, you got to let it grow. And then is it going to be the same price by the time it actually has beautiful ears of corn to sell?
Matured.
Yeah.
People can eat it.
So instead of going into your field and crying or building it's very sad farmer, or building a baseball field, if you build it, they will come. You could use a futures contract. So this is a type of derivative that locks in the price of corn today, even though you won't be able to sell it until the future.
Okay.
So AKA futures contract. So that's using a derivative to hedge a high risk.
Okay.
So let's say you're investing in hedge funds, which a lot of people do, private equity or real estate fund. Okay, let's take those three topics. A lot of those big players use derivatives to amplify gains and protect their downside.
Okay.
So let's now go into the main types of derivatives. Erin, break those bad boys down for us.
Yeah. So there's several common types. Each are used for different purposes. And I'm sure once we say these words, you're going to be like, oh, I've definitely heard some finance bro saying these things. Hopefully now you'll know maybe a little bit what that guy was talking about.
Yeah.
One of those being options. These are contracts that give you the right, but not the obligation to buy or sell an asset at a certain price within a set time.
Okay.
So an example here would be a call option on a tech stock. This gives you the option to buy the stock at a fixed price, which might become beneficial if the market price rises, right? Because you want to buy stock at the low price and watch it grow.
Yeah.
Then futures, these are agreements to buy or sell an asset at a future date for a set price, like you mentioned. This could be a coffee producer, may enter a futures contract to reduce uncertainty around future prices. Same as the corn.
Yeah.
And then there's swaps. These are contracts where two parties agree to exchange their cash flows. This is often used to manage interest rate and or currency risk. An example here could be a company that's earning revenue in euros might use a currency swap to manage exposure if their costs are in US dollars. And then there's forwards. These are custom agreements between parties to buy or sell an asset at a future date. These are similar to futures, but they're traded privately and are tailored to the specific parties that are involved.
Got it. Okay. So now I think we kind of know what derivatives are.
Got a base knowledge.
Got a base one. So let's switch it up and talk about why they even matter. Derivatives show up in the alts investing space because they're flexible, powerful, and they let you do stuff regular investing normally won't let you do.
Right.
So unlike traditional buy and hold assets like stocks or real estate, derivatives are used as a tool not owned for their intrinsic value. Okay. So, but when they're used thoughtfully, they may offer alternative ways to approach risk and opportunities in your portfolio, which is great. It's kind of like a Swiss Army knife of finance, if you will.
I like that.
So let's explore why derivatives are the VIPs in the alternative world.
Absolutely. So investors and institutions often explore derivatives for three big reasons. Number one, they help manage risk, like protecting a part of the portfolio from downside movement. We talked a bit about downside movement recently.
Yep.
So let's imagine that you're running a big global real estate fund. You have properties all over the world, Tokyo, London, and New York. They're big currency swings, right? Because you use different currencies in all of those places, could mess with your returns, right? So suddenly your London rental income's worth has become less because the pound has taken a nosedive, let's say. Scary, right? You can use currency swaps or futures to lock in the exchange rates to hedge against that risk.
That's good to know.
So you're not just sitting there hoping for the best, hoping that, the pound maintains its value. Number two, leverage. Derivatives provide exposure to price movement of an asset without committing to the whole shebang. You don't have to put the full amount of capital up front.
Got it.
So let's say you want exposure to oil prices, but you don't want to build the gigantic tank and roll a bunch of oil barrels and get into that business, right?
Yeah, I don't think my landlord will let me have an oil barrel on my...
I don't think so. You could ask, but I think the answer is going to be no.
Yeah, they're like, no, your balcony is too small. You can't even have an open flame grill, so...
No, I think no oil barrels for sure then. Instead, in this situation, you could use an oil features contract, and you can get exposure to that price movement without physically owning the asset.
Okay.
And that is called leverage, baby.
Yeah.
You put in less money up front, but you can gain or lose a lot more, depending.
But again,
hopefully gain.
Yes, but again, high risk, high reward, right?
Yep.
Don't they always teach us that? So this could explain why the pros in alternative investing using derivatives to enhance returns, but also why I have a feeling these regulators keep a very, very close eye on them.
You're right.
This isn't monopoly money that we're investing with, right?
No.
I wish it was.
That'd be fun.
Then I want to turn it into real money when I make the money. But when I lose it, it stays monopoly.
When you get out of jail.
Exactly.
Yeah.
So what would be the third reason why this method is used?
Yeah. Third reason would be custom strategies and flexibilities. People love this. The customizing is really important to people, savvy investors particularly. Yeah. It allows these brainy folks to get creative, and derivatives let you build strategies that go beyond just the buy low, sell high. It helps you bake in some additional things that could help protect you. So let's say that you think that a stock is going to stay flat, not go up or down. With a combo of options, you could actually make money if the price barely moves. It's kind of like betting almost, and it's called a straddle or a strangle. Basically, derivatives let investors hedge weird risks, amplify certain bets, and profit in all kinds of markets, up, down, sideways.
I like
turn around.
And turn around. I think customization is very it's huge in today's society. Like if I wasn't able to customize my Starbucks order or my food order,
it's almost expected in everything that we do now.
Exactly. So although derivatives can sound intimidating, in the right hands, they can be extremely, extremely powerful tools.
Yep.
They are kind of like the behind the scenes MVPs of alternative investing. Mm-hmm. They manage risk, make returns just a little bit more juicy, and they put the investors on a whole different playing field.
Yep.
So remember, they are tools, not toys.
Yeah.
And they do have risks associated with them.
Yeah, absolutely. And it's important to say that up front. Yeah. Derivatives are not appropriate for every investor. No. They involve real risk and complexities and should only be used when they're fully understood.
Right.
So I know that we just said that leverage is a good thing, but with derivatives, it can actually go both ways. The flip side is that the losses can pile up just as fast, sometimes faster than your potential wins. So that tiny amount of capital that you use to enter that big position, if that position goes south, then you're not just losing your money, you actually might owe more.
That would stink.
That would stink. It's not what you want, right? Yeah. Think of it as borrowing money to bet on a horse, and then the horse doesn't even finish the race or runs backwards on the track.
Sorry, Grandma. That was my grandma's horse. She ran backwards. Sorry, Grandma. We love you.
Yeah. But the track is going to want their money, right? You bet on this horse, you lost, whatever. Another risk to consider is the complexity and the misunderstandings that might come along with that. Some derivative strategies can get really complex really quickly. Yeah. So this could be layers on layers of contracts, models, and assumptions. Yeah. And then at that point, it's difficult to keep track of what any of this actually means. Which also means it's easy to screw it up.
Yeah.
If an investor doesn't fully understand what a derivative contract is doing, what triggers it, what moves it, what can go wrong, things can unravel really quickly, especially in volatile markets. Yeah. This isn't something that you just DIY, throw together.
No, please don't. Please don't.
Leave it to the pros or become a pro yourself, but don't just jump into it.
You hit the nail on the head 100%. And that might DIY. Don't be building something. Give it to
exactly.
it. So something else to consider is market volatility and liquidity in these. Derivatives can be super sensitive to market swings. So a little volatility can make their volume jump or even nosedive. So you got to be very careful. Yeah. And if there's no one to buy or sell them when you need to get out, what are you supposed to do? That's a huge liquidity risk that you're taking on. So some exotic derivatives don't have an attractive market, which means you might have to hold on to it. You're stuck with it.
Yeah.
Or if you're going to get rid of it, you might have to sell it at a loss. You thought it was worth a lot, but you're like, okay, I got to get rid of this bad boy and then I'm going to take a hit. I'm not going to get as much money as I was thinking. There's also a counterparty risk.
Okay.
Which this is new for most people. So some derivatives, especially over-the-counter ones, are
not prescription
derivatives, over-the-counter derivatives. They're private deals between two parties, okay? So two people, which means if the other side can't pay up, what happens? You're out of luck.
Yeah.
Okay. So this is a counterparty risk it's something that we need to really talk about, or you need to learn about. It's like making a bet with somebody and then finding out that their Venmo is actually empty when it's time to settle. And then they've changed their phone number, they've moved streets, they might have even left the country, and it's not like you can go and repo their crypto wallet.
Yeah, and that would be nice.
Yeah.
There are some people that I would like to do that to.
Tell me names.
That was a direct camera. That means it's serious.
I've got the shovel to hide the body.
But
Steve over here, we will take care of business.
We'll take you down and take your wallet. Always promoting violence on this podcast.
I know, it's okay.
Unfortunately. So something that you briefly touched upon on the last consideration was the regulation and transparency. Regulators do watch derivatives super closely, especially after that whole 2008 financial crisis thing.
I no idea what you're talking about. That little itty bitty blip in history where
thing that happened.
Everyone lost their houses and jobs and that one.
Hopes and dreams.
Yeah.
That. Exactly. So that particular crisis was caused in part by, bad bets with derivatives. So you can see why people would be cracking down on that. The feds would be cracking down. So in alternative investing, especially with hedge funds, there are rules about disclosure and how much risk that you can take on.
Yeah.
That's why an investor that's actually considering derivatives should do their homework and should ideally speak with a financial professional familiar with these instruments as per usual.
Always. So, all right. So we've talked about what a derivative is, why investors love them, and some of the scary stuff.
Yep.
So now it's time for the glow up.
All right.
Let's show these guys off a little bit. So let's chat about how to explore derivatives responsibly, aka how not to blow up your portfolio. We don't want people to do that, right? Yeah. So if you're curious about exploring derivatives as part of your investment learning, here are a few suggestions that we have to offer to our listeners. Know what you're using and why.
Yep.
Okay. Let's start very, very simple. You wouldn't drive a race car without knowing how the brakes work, right?
Yeah.
At least you would hope so.
How to drive.
So when it comes to derivatives, know what the contract is designed to do.
Right.
Hedge risks, generate income, express a market view. You need to know. If the answer is, I don't really know, that's your sign to hit the pause button.
Yeah.
Right there, right then and there. You know what? So don't use a sledgehammer basically to hang up a photo.
Yeah.
Okay.
Great point.
We don't want your portfolio to go in the toilet.
Yes.
Match the tool with the task, basically. This feels obvious, but worth repeating. Learn before you leap.
Yep.
Read perspectives. That's a doc that actually gives details about the offering. So ask questions, follow experts, even maybe take a course. We talked about this earlier, like become a pro, right? There are tons of resources out there and that breaks all this stuff down without melting your brain. Just you can do some Google on the Google, live on the Google,
and see what the resources out there are and get professional help.
Yeah, exactly.
I mean, that totally makes sense to me.
Yeah.
Another way to explore is the stress test strategy.
Okay.
Derivatives are affected by market swings, interest rates, volatility, time decay.
Yeah.
So responsible investors can actually run scenarios to see how things might play out. You can try paper trading through platforms like Thinkorswim or Webull to practice without real money on the line.
Yeah.
Use that monopoly money.
Yeah, exactly.
If your strategy only works when everything goes according to plan or perfectly well, it's not a strategy. You're just a wish, right?
Yeah.
It's hopeful thinking.
Yeah.
So this leads us directly into our next step. Keep your risk measurable. Tools like Value at Risk, VAR, or Greeks helps quantify how exposed you are to various factors, those factors that might affect your earnings, your income there.
Yep.
Even a simple stop loss strategy helps. The point is, don't fly blind.
Yeah.
You don't have to be an alts wizard, but you do need to understand your exposure. And I might even say maybe you should be a wizard.
Yeah.
But hey, sometimes less leverage is the smartest move.
Well, they do say less is more for a reason, right?
Yeah, I think they do.
Yeah. So the last few tips are kind of boring, but they 100% matter. Stay transparent and document everything. So whether you're an individual or part of a fund, record your rationale.
Yep.
Write down the reasonings why. You're not using derivatives, why you're using the derivatives, what you're expecting, what your plan is. Again, step by step, write down what you're thinking in your brain. So you can kind of, sometimes when you write it down, you see something that might be like, oh, that might not be what I was actually trying to do.
Yeah, right.
It's like keeping a workout log for your portfolio.
Okay. I like
This
that.
way, if something goes wrong, you've got those receipts.
Right.
Like, right here when I wrote this down, this is what I was doing.
Yep.
Last, know the rules.
Yeah, important.
Depending on where or how you're investing, regulations actually do matter. So some funds have limited limits on derivatives that you can use. So make sure you know how many. Some require disclosures. You've got to know the legal playground you're actually playing in. Okay.
Right.
So basically don't try to Wall Street stuff in your backyard without a permit. And with those lovely words of wisdom, that wraps up our episode today on derivatives.
Exactly. So let's give just a quick little recap here. Derivatives are financial contracts that are tied to the value of other assets and are widely used by institutions and some individual investors. While derivatives aren't a fit for every investor, for the right investor, it can be a great way to offer interesting possibilities for those seeking tools beyond traditional stocks and bonds, which is probably a lot of our listeners, right? We are talking about alternatives here, especially when used thoughtfully and with a proper risk awareness.
Yeah.
Like any alternative investment, the goal is to explore strategies that may support your long-term goals. Always have those long-term goals in mind. You don't want to just be chasing short-term gains blindly. You want to make sure that you have your long-term goals in mind and you're building your strategy to hopefully achieve those goals.
That's right. And when used strategically, they may offer potential benefits such as flexibility, diversification, or risk management. They also do carry significant risks and require careful understanding before use. Read the instructions here before use, right? Education, practice, and professional guidance are key for any investor exploring this space.
Yep, that's exactly right.
Yeah.
Well, thank you for tuning in. Like and share this episode. Follow us along. We talk about a lot more topics than just derivatives. Yeah. And stay curious and stay diversified. Thanks for joining us. Stay tuned for more insight on our next episode.
And don't forget to subscribe to continue the Alternative Investments Chat. See you next time.
Content provided in this podcast is for informational purposes only and should not be construed as professional, financial, or investment advice. This podcast should not be construed as an offer to sell or a solicitation of any offer to buy any securities. We strongly recommend that you seek advice from a qualified professional before making any financial decisions.